What if one man's economic plan could reshape the stock market, real estate values, and the global balance of trade, all within a few years? Donald Trump's market strategy, whether you love it or hate it, has already proven it can move trillions of dollars. But his newest proposals could be even more disruptive. Today, we're breaking down Trump's latest market plan, the winners and losers it could create, and what it means for your investments. Welcome back to MacroMentor, your source for clear, data-driven insights into global markets, investing trends, and the policies shaping our financial future. If you want to stay ahead of the headlines, hit like, subscribe, and turn on notifications so you never miss a market-shifting update. Before we dive into the new plan, let's rewind. Donald Trump's presidency from 2017 to 2021 was marked by some of the most aggressive economic policies in recent history. The hallmark: massive corporate tax cuts, sweeping deregulation, a trade war with China, and a focus on domestic energy independence. Markets reacted quickly. The Dow Jones Industrial Average surged from around 19,800 at the start of his term to over 29,000 before the pandemic crash. Corporate earnings rose sharply thanks to lower tax burdens. But the trade war also rattled global supply chains, causing volatility in manufacturing and commodity markets. Whether you credit or criticize his policies, one thing is clear: Trump's market moves are big, bold, and often polarizing. Fast forward to today. In recent speeches, interviews, and policy outlines, Trump has been signaling his next economic game plan. Key themes include extending or expanding corporate and individual tax cuts, ramping up tariffs on imports, especially from China and other trade competitors, further deregulating key industries, particularly energy and manufacturing, doubling down on U.S. energy dominance, including oil, gas, and possibly nuclear expansion, reworking international trade agreements to favor American exports and domestic jobs. According to Trump, the goal is to boost U.S. growth, strengthen the dollar, and make America the manufacturing superpower once again. Let's start with tax policy, a cornerstone of Trump's market approach. Lower corporate taxes historically lead to higher earnings per share, which can push stock prices upward. For example, the 2017 Tax Cuts and Jobs Act dropped the corporate tax rate from 35% to 21%, unleashing record-breaking stock buybacks and dividend payouts. If Trump extends these cuts or reduces them further, expect a rally in sectors with high effective tax rates, like industrials and retail. Increased cash flow for corporations, potentially boosting capital investment. However, this could also expand the federal deficit, which might push bond yields higher and pressure long-term government debt markets. Next, tariffs. Trump has proposed tariffs as high as 60% on certain Chinese imports and broad duties on other nations seen as unfair traders. The effects: short-term, higher input costs for U.S. companies dependent on imports. Think electronics, automotive parts, and consumer goods. Long-term, potential reshoring of manufacturing to the U.S., which could benefit domestic producers but strain global supply chains. Historically, Trump's tariff announcements have spiked volatility in the S&P 500, with tech and retail stocks often taking the biggest hits. Trump's emphasis on deregulation and energy independence could have sector-specific winners. Energy deregulation favors oil, gas, coal, and pipeline infrastructure, industries that boomed during his first term. If expanded, this could lower energy costs domestically, benefiting heavy manufacturing and transportation sectors. Increase exports of liquefied natural gas, LNG, boosting US trade balances. However, it may also clash with global climate agreements, affecting trade relations with Europe and other green-focused economies. Economists are divided on Trump's latest proposals. A Goldman Sachs analysis suggests that a return to aggressive tariffs could raise US inflation by 0.5 to 1 percentage point in the first year. Moody's Analytics estimates that making corporate tax cuts permanent could add 0.2% to annual GDP growth, but also increase the deficit by over $3 trillion in a decade. Energy analysts predict that a pro-fossil fuel agenda could add 500,000 jobs in the sector by 2028, while reducing renewable energy investment growth by up to 25%. If Trump's market plan takes shape, expect a sectoral divide. Likely winners: domestic manufacturing, energy producers, oil, gas, coal, defense contractors, financial services, benefiting from deregulation. Likely losers: multinational tech firms reliant on global supply chains, import-heavy retail brands, renewable energy developers facing reduced incentives. Geopolitically, nations reliant on US export markets could benefit, while those facing steep tariffs may pivot toward BRICS and alternative trade alliances. So what does this mean for your portfolio? Diversified geographically. Tariffs could hurt foreign-exposed companies, so balance US holdings with select emerging markets. Watch commodity plays. Energy and defense stocks could be strong performers. Stay alert to bond yields. Deficit expansion could drive interest rates higher, impacting bond prices. Consider hedges. Gold and other safe haven assets often gain in times of trade uncertainty. This isn't about politics. It's about positioning your money where the policy winds are blowing. Donald Trump's market plan could be a catalyst for massive economic shifts, both opportunities and risks. The question isn't whether you agree with his politics. The real question is, are you ready for the market that could emerge if this plan becomes reality? If you found this breakdown useful, hit like, subscribe, and turn on notifications so you're prepared for the policies that could shape your portfolio in the years ahead.